Could you walk me through a concrete example of how the asset financing process works in practice?
Sure, I'll try and keep it as short as I can. But the way it's worked to date is a little bit different than how it'll work in the future. But today on Centrifuge, I think there's 12 or 13 different pools that are live and being actively managed on the Centrifuge protocol, right? The beauty and I guess the difficulty of real world assets is that we have to merge the worlds of kind of off-chain collateral and the legal structures and the risk structures that exist from traditional finance. And we have to merge that or find the right way to pair that kind of with the world of on-chain smart contracts, NFTs, and of course, just like the broader blockchain. So the way it works today is that for any institution that wants to, or any organization that wants to finance real world assets on chain, they have to first provide kind of the legal structure that underpins everything that you see on the Tin Lake dApp. So this requires all of the legal structuring that comes from traditional finance, all of the checks and balances that you would have in a traditional debt offering. And then those organizations have to meet those expectations and then share that information and make that information available to any investor that may need to understand the claim on the collateral, the legal structure, and what they're actually investing in. So for all the pools on Centrifuge, you can see the executive summary. You can request, which houses all of the investment information. You can request to sign an NDA and learn more about the investment and get access to any of the information that you would need to feel comfortable investing in such a pool, right? And so I think a lot of the work that we continue to do, and I think we continue to lead at Centrifuge, is how do we make these investments on chain safe by taking the best practices from the off-chain world and ensuring that that information is available and those processes are being followed by the pools that you see on Centrifuge today and going forward.
Got it. Now, this is super interesting because it's for sure a bit of a hot topic right now. If you go to the governance forums of different lending protocols, real world assets are kind of a polarizing subject in some sense. You have strong arguments both for and against, where the for side is that if you want to unlock full potential of lending on chain, you need to onboard real world assets because that's what makes up the bulk of collateral in this real world we live in. And against, you can argue that involving off-chain transactions and aspects to DeFi would make you lose some efficiency, reliability, automation, and enforcing contracts might be difficult. And related to that, could you walk us through how the process of enforcing these collateral contracts actually works in practice if someone were to say default on their mortgage?
Yep. So every industry has a different set of third parties that cater to this process, right? So you have things like verification agents, payment agents, all of these different legal structures that really ensure that any investment that any investor is making, right, there is a process for securing that collateral off chain. So I can't give you a blanket answer in the sense that it's very simple. Every pool or every fund does this exactly the same way. What I can say, right, is like every pool that you're looking at on Centrifuge is its own standalone SPV, right? And the idea is that the collateral being put into that SPV is bankruptcy remote from the person that's actually managing the investment, right? So the claim on that collateral, right, and the legal recourse for actually securing that collateral in case of default is managed off-chain and is managed by each pool. And any investor should they need to get access to that information, would have to actually go through a discussion or an evaluation of each pool, right? And a lot of the institutional investors, and I would say more of the structured credit and traditional credit investors that are beginning, in my opinion, I think we're seeing this across DeFi, beginning to come into DeFi, they're starting to raise a lot of those questions, bring a lot of that expertise and a lot of the diligence and risk assessment that's needed as they're managing not a couple 100,000 or even a couple million, but they're managing hundreds of millions, if not billions, in capital on behalf of their investors. And when they make that investment, you can be sure that they need to know how they're going to get a claim on that collateral or what happens in the case of default. I think the broader answer I would give there, though, Ascari, especially when you think about more of the retail investment side, is that it's the reason that you actually securitize debt on chain through Centrifuge, right? Because as a senior investor, ultimately you want to be protected by the junior tranche, right? And you should understand the way that the pool is structured and the way the risk is priced, of course. And the assumption that you should make, that I would be making, right, or the diligence that any investor should be doing, is ensuring that if they invest in the senior tranche, when there are defaults, right, and inevitably there will be defaults in the real world, what you want the senior tranche to do is ultimately be protected. And the groups that are investing in the junior tranche, they're really taking that first risk and that first loss. They have the appetite for it, and they also have run the analysis to know what the default rates might be. And in case of default, know that they will take a financial hit when that does occur. And so that's why I think we want to be continuing to push the on-chain infrastructure of Centrifuge from single AB tranche, as it is today, a senior and a junior tranche, into really multiple tranches of risk through a Centrifuge, through a pool that's launched on Centrifuge. Because in that way, you can actually allow different investors that have different risk appetites to access different parts of the cap structure and invest into a Centrifuge pool at the place where the investment returns or the yield matches their risk appetite.